Well, hello everyone. Glad to have you with us tonight. My name is Neil Angel, and the president of FinLife. And in cooperation with First Sun EAP, we're pleased to bring a webinar tonight to talk with you about some of the decisions that you have to make in transitioning from paycheck income to retirement income. And the key here is to be able to squeeze more juice out of the lemon. In other words, to be able to maintain as much of your lifestyle that you enjoyed during your working years, even during your retirement years, without running out of money. That's the challenge. And I'm excited tonight to be able to introduce to you a special guest coming to us from Denver, Colorado, Bruce Larson. And the reason I'm excited about Bruce is not only the fact that he is the author of a very well respected book in our practice, which is A Concise Guide to Taxes and Retirement, but he also works as a mentor to advisors like me all over the country. And he actually has developed software to help us work with clients to assess their tax potential tax liability in retirement. One of the things that I found with retirees, especially in early retirement, is they think that if they can just get a reasonable rate of return, let's say 5 or 6%, and limit the withdrawals from their retirement accounts, then they're going to be successful. The problem with that is that there are a number of decisions that have absolutely nothing to do with the rate of return that you get on your money that impact the success or the failure of your retirement. We're going to be talking about some of those decisions tonight. Namely, we're going to be talking about Social Security and Medicare, but also looking at the implications for taxes on retirement and look at how you can use various strategies to mitigate taxes as you retire. So, welcome, Bruce. Glad to have you with us and looking forward to hearing more from you.
Okay, thanks, Neil. Yes, I wrote the first edition of my book. It's now on its, I believe, fifth edition. Wrote it back in 2016, and I heard from a lot of advisors that they really like the strategies, but they had no way of modeling. That's why I wrote Tax Acuity that allows us to put in a client's situation, maybe while they're still working, and then show the difference in their taxes once they retire. And there's a line that I think gets repeated way too much. I hear it all the time that your biggest expense in retirement is going to be taxes. Well, for most people, that just isn't the case if proper planning's done. But again, you do have to do proper planning to get that tax bill down. So let's just launch into it and let's start by looking at effective Social Security strategies. Uh, and when we do this, we want to look at both sides of the Social Security filing equation. I'll go through a slide on the next slide that demonstrates that. We'll want to pay particular attention to survivor benefits. I'll talk about them in more detail, but the bottom line is if we have a couple, the survivor, if one of them passes early, the survivor keeps the larger of the two benefits. So, you'll hear a lot of times, oh, everybody should wait till 70. Well, maybe it's only the higher earner that should wait till 70 because they can get more out of the system. So it's not just a one size fits all answer. And then we'll also take a good look at the tax issues with Social Security because up to 85% of your Social Security benefit could be taxed if you don't do the proper planning. Okay, so let's look at an example. I've found that examples usually explain kind of complex issues better. And here we're talking about both sides of the Social Security equation. Okay, both spouses are 67, and we've got a life expectancy for both of 90 years. So if the first spouse files immediately, he will get 3,456. If he waits till 70, that amount will go up 8% per year, simple interest, until he reaches 70. The other spouse is entitled to 225.92 at age 67. If this person waits till 70, it moves up to 3,040. Okay, so most Social Security planning stops at the first point here. It says, well, if they both live to 90, by delaying to age 70, they would receive 217,000 more in benefits. So for most people, that seems to make a lot of sense. Okay, here's the problem. When we look at the other side of the equation, we realize that during the period they're delaying their benefits, they want the bigger benefits, so they're not taking anything till age 70. They're going to have to spend down 148,000 of other assets from somewhere, either from their IRAs, 401ks, savings, what have you. But they've got to spend this money down in order to get this much more in benefits. Well, if you look at how long they've got to go before they reach age 90, if I had that 148,000, I'd only have to get a 1.68% return to equal this 217,000. So it isn't just about how much you can squeeze out of Social Security, it's about what you have to do to get there. So for most people, when they're ready to retire, if they've hit at least full retirement age, typically the answer is, okay, let's take it right now. Unless we really need to maximize that survivor benefit. And then it's just a matter of looking at all the other available assets to see if we really do need to get that survivor benefit up. So don't just take the default answer here to say, oh, I'm going to get 217,000 more, so I should do that. It's not that simple.
Wow, Bruce, this is really fascinating. It's funny. A lot of times it really comes down to a four-letter word, which is math. And I think you've given me a different perspective just in that first slide. Let me make a recommendation. I'm going to transition to this next slide, but I'm sure people didn't sign up to see our ugly mugs. So I'm going to take us off of camera and enlarge the screen so people can better see what you're talking about. Does that sound like
Yeah, that'd be good because some of this stuff is a little bit detailed, unfortunately. So the more screen real estate we can get for the slides, the better.
excellent? Okay.
And the majority of the people I work with, when they retire, we typically turn the Social Security on immediately. Okay. But there's one other thing we need to address, and that's survivor benefits. So the way survivor benefits work, I already alluded to this, is if the survivor is reached full retirement age, the survivor benefit will be the larger of the two benefits. So whoever, it doesn't matter who passes away first, the survivor keeps the larger of the two. And what's neat about that is taking a survivor benefit has no effect on your own benefit, leading to some planning opportunities. For instance, we may have a survivor benefit that's smaller than your own benefit. Well, if we take the survivor benefit, we can let our own benefit grow until age 70. So there's lots of ways that we can mix and match this. And another thing that you want to look at is if you had a previous marriage. I met with a nice lady about 6 months ago. She was getting ready to retire. She was 67, and she had never earned much money throughout her career. Her benefit was only going to be about $1,900. But I asked her, I said, did you have any previous marriages? She says, yes, I got married fairly young. My husband went to college, became a dentist, practiced for about 5 years, and then he passed away. Okay, well, the survivor benefit on that person that had passed away over 30 years ago was based on what his earnings were at the time and carried forward all the way up to his full retirement age. So we called Social Security and found out she could get about a $3,800 benefit from somebody that had been passed away for 30 years. So I always want to really question people on just what their family situation has been like over their lifetime. Because people that were married more than once, you can kind of pick and choose which benefit to take. As long as you were married for 10 years, you can actually get a spousal benefit from an ex-spouse. And in one instance, I had a client take a spousal benefit for a few years, and then one of her other spouses, she was kind of a chronic marrier, but one of the other spouses passed away. So now she's eligible for that survivor benefit. So Social Security planning for people that have a lot of changes over their lifetime isn't a one-time thing. Often we can find benefits that people didn't even know they were entitled to. Okay, so let's look at survivor benefit for the example we just used. Remember, spouse one gets 3456 today or 4053 at age 70. Spouse two, 2592 or 30,040. And let's say they've got $1 million in IRAs. They've done a good job, socked a lot of money away in their 401ks, and they're planning on taking 5% distributions, which is, in my mind, could be excessive unless they do some um, pretty involved planning. And they've also got 150,000 in a CD that's paying them 4%. So let's look at what happens if we just delay his benefit until age 70. So that'll be an increase of $7,164. And we're going to reduce the IRA distribution rate down to 4%. So instead of getting 50,000 a year, they're going to get 40,000 a year. And we're going to spend down some of this CD money while we're delaying his benefit. So let's see what happens. Well, a lot of really good things happen. Okay. Their taxable Social Security drops from $47,045 down to $37,340, even though they've got $71.64 more in increased benefits. That seems like magic, doesn't it? Well, the reason that happens is when you calculate the taxation of your Social Security. And if you want to do this by yourself, the IRS provides a wonderful little 16-step worksheet you can go through. I got so tired of that worksheet. That was one of the drivers of me creating my software. But when they figure out how much of your Social Security is going to be taxed, they take your adjusted gross income before Social Security, and then they add 1/2 of your Social Security to that. Okay. So it's kind of like a teeter-totter. If we can increase Social Security, reduce other income like IRA distributions, we end up with less taxes, even though we have more in Social Security benefits. So it's a really neat thing about the way Social Security works. Okay. Now because we delayed his benefit for 3 years, the survivor benefits increased by 24%. So if one person passes away, they've got a lot more money they can depend on. And by the way, Social Security does have cost of living adjustments, so they've got more income that's inflation protected. Okay, that's a good thing. No matter how you look at it, that in my mind is a very good thing. Now we've also, by doing this, we've reduced their taxes by 44%. Just because we've decreased that ordinary income, we've increased Social Security. So we've almost cut their taxes in half by doing this. Okay. And despite we've got a 6% decrease in gross income because of less IRA distributions, their their net after tax income actually goes up by 1%. So even though I said before delaying Social Security benefits may not make sense just because you get more out, when you factor in survivor benefit planning, then a lot of times that can change the equation. Okay, so we've got to look at things in total. And another thing that's good here is they're taking a much safer 4% distribution rate from their IRAs. And a lot of times people are surprised. They think 4%, I've been getting 7 or 8% all these years. Why am I only taking 4% out? Well, we have to factor in inflation. Okay, so a safe retirement portfolio long term is probably going to get about 6.5%, maybe 7. Probably 7's a little bit more reasonable. And if we run a 3% inflation rate, we've got to hold back 3% of that gain so we can increase the portfolio balance. So over time, we can increase our distributions to cover inflation. Okay, so another thing that you've got to have a very, very clear understanding is the Social Security effective marginal rate. You may not have heard of this before. I actually trademarked the term because it is so critical that this is understood. Okay. So remember, I said that when they calculate your taxation of Social Security, they add your AGI plus half the Social Security. So until you get to a point where 85% of your Social Security is taxable, which is the max, and by the way, you don't hit that typically until you're about 150,000 of net after tax income. So the majority of the people don't ever get to 85% taxation of their Social Security. But each additional dollar of ordinary income, say you take another dollar out of your IRA, that causes another 85 cents of your Social Security to become taxable. Okay, that's not a good thing, right? So what effectively happens if you're in the 12% bracket, your Social Security effective marginal rate is 22.2%. And I see people making mistakes on this constantly, even if they're working with their tax preparer, because they'll call him up and say, "Hey, I want to take out another $10,000 to take a trip or whatever." And the tax guy will look at their return and say, "Well, you're in the 12% bracket, so withhold $1,200 from that distribution for federal taxes." Okay. Well, they're going to get about $1,100 surprise come tax time, because that caused more of their Social Security to become taxable. So they really should have withheld 22.2% or $2,220. Okay. Now, where this really gets people in trouble is they say, okay, I want 10,000 net out. So what you have to do then is you have to gross up that distribution by a little bit more than 22%, because not only is the 10,000 taxable, but the amount you grossed it up to cover the taxes, that's also taxable. But now we've got to withhold even more to cover the taxes on that. And you end up on this hamster wheel of taxes, to where you can actually, on a $10,000 distribution, you can have to gross it up by about $4,000 to get your net 10,000, depending on other factors. But that's commonly where I see it come in. So for that reason, we try to segregate what we call the qualified money. That's the money in 401ks and IRAs. Segregate that from the taxable money, which is, you know, savings, brokerage accounts, that sort of thing. And then the third area is Roth accounts, which are tax free, along with permanent life insurance, the cash value of permanent life insurance. So we want to try to avoid using that IRA as a piggy bank. You know, the amount that's in savings, we're getting interest income off that. It's already taxed. So if we pull some money out of savings, that causes us no additional problems. Same way with pulling money out of a Roth or taking a loan from the cash value of life insurance. So we want to use the IRA as typically the main income source, but we want to try to set that up on nice, even, typically monthly distributions. We'll withhold enough taxes to cover it, but we don't want to get in a situation where we have to reach in and pull money out. Now, some people, all they have is qualified money, so we really have no choice. At that point, we just have to segregate some of the IRA money kind of off to the side as a rainy day fund, while the other part of it we're using to uh, provide ongoing income. Now, to make things look even worse, if you get to the 22% bracket, which you hit that at about, I can't remember, it's about 98,000 for a joint couple. But now your effective Social Security effective marginal tax rate is 40.7. Okay. And we all know that the top marginal rate is 37%. Well, you're paying more taxes on additional IRA distributions than billionaires are. So it's something that's really ugly in the situation. But we go back up to the top here and say this only applies up until 85% of your Social Security is taxable. So but that's a pretty wide window of people. That's anybody from about 50,000 net after tax up to about 150,000. So the majority of the people we work with fall into that, and that 50,000 to 150, that's net after tax income. Okay. Now another thing that happens, and I don't think a month goes by that I don't have one of these cases where one of the advisors I work with calls up and says, these people are, they're only spend their net after tax, or their taxable income is only about 75,000. So I told them they could take a $20,000 capital gain, because their capital gain tax rate is zero. So if your taxable income is 96.7 for a joint couple, or 48,350 for a single person, your capital gain tax rate is zero. So they thought they could pull out, 20,000 in capital gain and it would have no effect on them. And while it's true that the capital gain is not taxable, which it isn't, but it's causing more of their Social Security to become taxable. So, they haven't hit the 15% capital gains rate, but effectively they're paying 10.2% on that capital gain because it caused more taxation of their Social Security. Okay, so what I do with all of my clients is I just set up a tax profile for them in my software. And if they just have no choice but to pull some money out of an IRA, at least we plug it in and we know how much to withhold so they don't get an ugly surprise come tax time. Okay, so it's critical that you're monitoring your taxes really throughout your lifetime because everything changes every year with taxes. This year we got a great break for people 65 or older that if you're under 150,000 in taxable income, you've picked up another 12,000 in standard deduction. So, but that only lasts until 2028. So, we've always got to be doing tax planning every single year. Okay, excuse me. Realistic distribution rates. We've mentioned this before. Most advisors recommend a distribution rate of no more than 3.5 to 4% to maintain the account balance and to increase distributions to cover inflation. Now, what I've found with most of my clients is they kind of do a mental accounting with their money to where they look at the qualified money, the IRA and 401k money, that's money to cover retirement. Okay, so they're really not concerned about maintaining the account balance. They don't mind spending that down because, if they have kids or grandkids, they want to leave something too. There's usually the house or some non-qualified money, savings or a brokerage account. So if maintaining an account balance really isn't a priority, you can actually increase the distribution rate to a little bit north of 5%. So kind of keep those two numbers in mind when you're looking at your qualified money and just, kind of discuss it if you're a couple. Do we really care if we maintain this account balance or can we spend it down if we've got other assets that can cover the kids? And, it's becoming seem more and more common that I mean, with people that just don't have any kids. So yeah, they're the typical line I hear is we want the second check to the funeral home to bounce. We want to spend every dime we have so that we can have the most fulfilling retirement that we can. Okay, Medicare. I'm not going to spend a lot of time on Medicare other than to say there's two different ways you can take Medicare. You can get the Part A, Part B, Part D, and then buy a supplement, or you can roll it all into Part C. Okay, that's a Medicare Advantage plan. And the critical things to keep in mind, it's critical that you file when you're eligible. If you're retired, that age is 65. If you continue to be covered by a group health plan, though, you can wait until you're no longer eligible for the group health plan. So let's say you both work until 67, you can wait until then. Okay. And you want to choose a plan that fits you for your entire life. Okay, the Medicare Advantage plans are very attractive because they're very low cost. They're much less expensive than doing the Part B, Part D with a supplement. The problem is when you really start needing it, when your health starts deteriorating in old age, they become very expensive because they have deductibles and copays. Okay. And the issue with it is when you first become eligible in Medicare, you can choose any plan that's available in your area. They can't deny you for any health reasons. But if you ever want to switch, they can health rate you. So I've heard people say, well, I'll use the Advantage plan until my health goes downhill and then I'll get a supplement. That doesn't work because they probably won't take you. So I would much rather pay for the supplement and have some certainty in my planning than knowing that I might have to start coughing up thousands of dollars when my health starts deteriorating and I start running into these copays and deductibles. Okay. Be aware of increased penalties for other earnings for higher earners. If your income is over 106,000 as a single person or over 212,000, then you will have a Medicare premium penalty, which means you will pay more for your Part B and Part D premiums. Okay, and most people look at it and say, "Hey, we're not going to have 212,000 in retirement." But let's say you sold a rental property and you have a big capital gain. If it's been depreciated out, the entire price of it is basically gain. Or if you have a business that you sell, or if you liquidate a stock, those capital gains count as income. So you can be over the edge, and then they'll penalize your Medicare premiums. And they do this. They look at your income 2 years previously, and then the penalty comes 2 years later. But then it doesn't last forever. If you just had a one-time high income event, you can request that your premium be put back to where it should be, and you can get out from under that over time. Another place that this comes into play is for people attempting to do large Roth conversions. So typically what we'll do, instead of doing one big Roth conversion, we'll spread it out over several years so that we don't get into this penalty phase. Because if you hit the max penalty, you can be paying over 10,000 more a year for your Medicare premiums. Final point on this, and this is why I'm not going into a lot of detail on Medicare, is use a licensed Medicare agent. Okay, if you use an agent, you don't spend any more for your premiums than if you searched out a plan on your own. These people are very experienced, they're very highly regulated, so don't try to navigate the morass of Medicare without some help. These people are just very good at what they do, and they will get you in a plan that's going to fit you for the long term. Okay, now my favorite topic. Let's talk a little bit about tax planning. Okay, and I say there's three levels of tax planning. There's probably the most common, where they've got sufficient savings and investments to provide a comfortable retirement along with any benefits, Social Security or pensions. Well, what's key here is good Social Security planning that we talked about earlier. Then we want to give you the best lifestyle possible. So we want to try to maximize those qualified plan distributions. And the way this typically works out is we ask people, what do you need? Okay, we plug in all of their numbers. And if we can meet this need and still have something left over, and we can supply that need on a very secure basis, then that opens the door to basically have permission to go spend that other money. If we've got money that we don't need to actually cover the day-to-day needs, then go enjoy your retirement on the excess. We also look at sheltering non-qualified assets. If you've got a big, let's say a CD account with a couple $100,000 in it, or a high yield money fund, let's say that thing is, I don't know, kicking off 10,000 a year in interest income. Well, you're not just paying tax on the interest income. Now it's going into that Social Security area. So you could potentially and most likely be paying at least 22.2% on that interest income. Well, it's very easy to shelter that income with a high level of liquidity to where we don't have to pay taxes until we actually reach in and get some money. Okay, a lot of people's in their savings and their non-qualified investments, brokerage accounts, they're typically not spending the money. They're just reinvesting it, and it's just growing. And each year the tax bill is getting larger and larger. And if it's costing you, say, another, I don't know, call it 5,000 a year in taxes, well, over 20 years, that's $100,000 that you paid in taxes that you just didn't need to pay if you never had to access those funds. I see this a lot with people that inherit from their parents. They want to preserve it for their kids, so they're not gonna spend that money down. Well, if we shelter it, you're going to have a heck of a lot more money to leave your kids than if you're paying taxes along the way on it. We also very closely look at survivor protection. What happens when one spouse passes away? It's kind of sad that we don't check out together, but it's very rare that that happens. And when we look at most situations, if one spouse passes away, we lose one Social Security benefit. we lose half the standard deduction, and now we're on the single tax table. Okay, what that usually equals is we see about a 30% reduction in net after tax income. So it's critical that we're aware of that so that we can plan for it and be ready for it. Okay. And we also need to provide liquidity for contingencies. We need to always need to maintain a rainy day fund because rainy days do come. So we need to be cognizant of that and have that ready to go so that if, we need to put a transmission in the car or what have you, we've got some money that we can reach in and get to cover that. Okay, now level two planning, those are people where the required minimum distributions are excessive. Let's say we only need to pull out, let's say 30,000 out of our IRAs or 401ks to make our retirement plan work. But once we hit RMD age, which for people reaching that today is age 73, for younger people it's age 75. But if we reach RMD age and the required minimum distribution is 50,000, now we've got 20,000 of excess income we're having to pay taxes on even though we don't need it. Okay, then we reinvest it into a non-qualified investment account. Maybe it's just CDs or it's a brokerage account, what have you. But now that's also going to kick out more taxable income. So we kind of put ourselves in a mess. So the strategies we use for people that are going to have excess uh, RMDs is we use all the level one strategies. We don't abandon those. But then we look at another Social Security planning option, which is a delay and spend down. If those RMDs aren't huge, it may make sense to delay both Social Security benefits till 70, spend down some of those IRAs now, and we'll end up paying a little bit more taxes during that spend down period. But then once we hit RMD age, if those RMDs are closer to what we actually need, then that can put us in a better tax situation for the rest of our lives because we've got higher Social Security income with lower IRA distributions. We also look at Roth conversions. And as I mentioned before, we want to be very careful on them and take everything into account. It's not just the taxes we pay on the amount we're converting to a Roth, but it's also the potentially a Medicare penalty. So we want to make sure that we're looking at everything from all angles before we launch into this. We also can look at charitable strategies. And that's not just for these people, it's kind of for everybody. If you're contributing to a charity on an ongoing basis, once you reach the year you reach age 70 and a half, you can do qualified charitable distributions, which means as long as you've got a qualified charity in mind, which is most churches, most any other charity, as long as it's a public charity, you can distribute money out of your IRA directly to the charity, and that distribution is excluded. So it's much better than a deduction because a deduction, first that money has to hit your adjusted gross income, then it's deducted. Well, if it hits your adjusted gross income, it causes more of your Social Security to become taxable. If it's excluded, it doesn't hit AGI, so it doesn't affect the taxation of your Social Security. So if you are giving to charity on an ongoing basis, and that's something you want to continue, you certainly want to look at some of the charitable strategies that you can employ. Okay, level three, these are people that the projected value of their estate will exceed the estate exclusion. Well, for most people, that isn't something that's going to happen because next year the exclusion goes all the way up to 15 million per person. So for a couple, if they do everything right, that can be 30 million uh, in estate value that's completely excluded. So for most people, it isn't an issue. Although there are people that I've worked with, even blue collar people that find themselves in this situation. I'm working with a client right now that he was working for a company. He was one of the early people in the company. They created an ESOP, the company, which is a type of 401k plan, and the company just did fantastic. That stock just went through the roof. So now this guy finds himself with excess IRA distributions because him and his wife don't plan on changing their lifestyle. But then they're also looking at huge estate taxes having to be paid. So there's several ways. Estate taxes are completely discretionary. You don't have to pay them if you use the right kind of planning. We can do lifetime transfers through different trust strategies. We can use charitable strategies for highly appreciated assets, and we can utilize annual gift tax exclusion. Each person can gift up to 19,000 per year to anybody that they want to. So, if a couple has two kids, they can each give 19,000 each kid, so they in total they can gift 76,000. So for somebody that's in an estate tax situation, that doesn't seem like a lot. But if you gifted that into a properly structured trust and bought life insurance, you could probably buy a policy for $4 or $5 million, and that would go a long ways towards paying the estate taxes. So there's lots of different strategies we can do if you find yourself in this position. And it's kind of surprising to me the people that end up here. It's people that are really good savers and, frankly, people that had a lot of good luck along the way or received a big inheritance themselves. So, regardless of whether it's level 1, 2, or 3 tax planning, we have the capabilities that we can walk you through what your options are and get your tax bill down. And if we go back and look at level 1 people, about the best news that you can give people is if you can cut their taxes. And most people going in this situation, going from work to retirement and wanting the same in net after tax income, I can typically reduce their taxes by 40 to 60%. So that's a pretty nice outcome. Just because you retired, your tax bill drops by that amount of money. So it's entirely possible. Just take some good planning, and we can get you there. Okay, so hopefully what you've gathered from everything I've been talking about is that retirement planning, it's a multivariable calculation. If we change one thing, it tends to have a cascading effect on other areas. So we want to really look at everything in totality. And the default plan typically is not the most optimal. Just because your neighbor did it doesn't mean it fits you. Just because your brother did it doesn't mean it fits you. You really need to tear everything apart, look at everything, and see what really fits you the best. Now, as part of working with Neil's organization, I've budgeted out time over the next few weeks that if you'd like a retirement readiness meeting with me, take about 30 minutes. Basically, I'll send you a questionnaire on data that I need, and we'll just look over your situation and see how ready you are to actually step into retirement. See what kind of pitfalls there might be, things that you need to be aware of. So there's a chat box that I believe Neil can put the link to my calendar in there. Once you schedule with me, I'll send you an email on what to have to provide me ahead of time, and also what to have on hand when we actually meet. Because I know a lot of people don't want to send any confidential information. That's perfectly fine. I get it. I am a licensed tax preparer, so what comes with that is a confidentiality agreement. So I'm certainly not going to share your data with anybody. But let me take a look. I love doing this. I've been doing it for 27 years, and every engagement is unique. Everybody is different. So I'd love to work with you and see what we can come up with to really, really get you on track to a comfortable retirement. So, Neil, I didn't ask you along the way. I got a little bit of, I guess, tied into what I was talking about. Have we had any questions pop up?
Not yet. I haven't made that open, but if anyone has any questions that they would want to include in the chat box, feel free to do so. And also, let me direct your attention to the chat box. I did mention the fact that we are providing a special offer for those of you who are sticking around to the end. And of course, that is a meeting with Bruce. And at the same time, if you are meeting with him and are interested in taking this to the next level, we can talk to you about making his book available to you, A Concise Guide to Taxes in Retirement. So I have included on the chat box a link to a forms, Microsoft Forms, with a quick survey of 5 questions. And what I would ask you to do is, as a starting place, fill that out. And then what I will do when I get your response is I will send you Bruce's calendar so you can schedule a time directly with him to discuss your own particular situation in confidence. And one of the things I wanted to mention to you just in passing as we're sort of winding up this conversation tonight is a concept that Bruce introduced. I don't know if you caught that, but he mentioned something that I think should catch your attention, and that was the idea of tax planning. Now, if you take your taxes every year to your CPA or other tax firm, or maybe you go to H&R Block or you use TurboTax and what have you, the goal there is to prepare your taxes. It's really reporting is all you're doing. You're reporting on the activities of the previous year and determining how much money you need to pay the IRS. But there's a new concept out there, which I don't know if you call, but it's tax planning. That's completely separate from preparing your tax returns. And when most people are filling out their returns or they're taking that to the CPA each year, their whole focus is just on minimizing the pain in taxes they're paying that year. But what Bruce is talking about here is taking the long view and looking at the implications on a number of different things. As you can see, he mentioned the implications when it comes to taxes on your Social Security, taxes on your retirement accounts, and so forth. So there are a number of different variables here that you probably haven't been aware of that can directly impact the taxes that you pay in retirement and the kind of lifestyle that you can enjoy in retirement. And I often say when it comes to taxes, it's not what you make that counts, it's what you keep that counts. So if you would want to focus on keeping more of your money and sending less to Uncle Sam and more to yourself and to your family or your community, then I would encourage you to start with the form that I sent in the chat box, fill out that survey, and then we can continue the conversation offline with you confidentially after the fact. Bruce, do you have any other comments you want to make?
Yeah, as I mentioned in the intro, I do have my own tax practice. So, uh, what the thing that all tax preparers hate the most is giving bad news to a client. I brought on a new tax client. She said, my situation's very simple. So it won't take much. So I, put her in at my minimum rate. And come to find out, I get this 1099 from a brokerage account. And this poor lady owes $35,000 that she didn't expect. This is a woman that is comfortable living on 50,000 a year. And with some proper tax planning, the result may have been the same, but she would have been prepared for it. I was dreading having that meeting with her to have to give her that bad news uh, that gain, that tax she paid, we could have avoided at least half of it very easily through just some different staging uh, plans. So, there's nothing worse than sitting down with your tax preparer and having him say, well, I've got some bad news. If you hadn't have done this, you would have been in much better shape. And we don't want to do it that way. We want to know almost to the penny exactly what you're going to be paying in taxes so that we don't have any of those ugly surprises. I just hate having to give bad news to a client. So I'd much rather do the planning, and that is part of my tax practice. I do not do a return unless we also include the tax plan with it, because it's key that if all you're doing is the return, you're kind of driving down the road only looking in the rearview mirror. You've got to be looking ahead. So certainly, if you'd like me to do a retirement readiness visit with you, I'm happy to do it. We don't charge anything for that. That's just part of Neil's program. So uh, if we don't have any questions, we will turn you loose for the evening. And please do fill out those surveys because I want to always be improving. And if there is something that I went too fast on, just let me know how we can do better next time.
Yeah,
And certainly send us an email as well, because we will respond to those surveys directly. So that I'd love to get even more direct feedback from you if you're willing.
absolutely. Yeah, and let me just mention this too for those of you who have joined us tonight. Most of you are from South Carolina. You're members of First Son EAP, who is the sponsor for tonight's event, which I want to thank. But Bruce is able to represent clients all over the country, and that's one of the key differences between CPAs and enrolled agents. I'm not sure if you're familiar with that, but enrolled agents are able to represent their clients with the IRS nationwide, whereas CPAs are licensed state by state. So the fact that Bruce is in Denver should not be an impediment to you. Of course, nowadays with Zoom and all of the other technologies we have at our disposal, it's much easier to work with people uh, across the country. And so I would highly recommend that you talk with Bruce if you don't have a tax advisor, because you obviously want someone who understands the implications, not just for this past year, but also looking forward to your future retirement. So, with that, I want to thank everyone for attending, and just we'll look forward to hearing from those of you who would like to engage with us after the fact. Have a good evening, everyone.
Thanks for
Thank you,
coming.
Bruce.
Yep. Thank you. Thanks, Neil, for setting this up. And I look forward to doing more of these. These are fun, and we will improve them based on the feedback we get.
Very good. Thank you, everyone.